Good morning and welcome to the Killik podcast for Friday the 20th of March. Key event this week was the budget, with 48 days to go to the general election. We're watching this closely as ever. Here we've had a quick look through the sectors that it affected in terms of the share prices on the announcement. The first one was the house builders and the estate agents and building materials. They were helped by Help to Buy ISA that was introduced that should aid around 10,000 people to buy new homes that wouldn't have been able to otherwise. Equally, there was further commitments to urban generation, which should deliver around 43,000 additional homes. So that was particularly good for the London exposed stocks in that sector. Next sector was diversified financials. So we saw strong moves from Hargreaves Lansdown, St James's Place on further scope for them to benefit from pension reform. So we've got further freedom for around 5 million pensioners to sell their annuities. And we've seen further enhancements to the savings industry in initiatives such as flexible ISAs. The third sector was the oil and gas sector. Here, obviously, the falling oil prices affected the profitability of a lot of the operators in this area. So we've seen quite a significant tax cut for North Sea operators from 30 to 20%, promoting an additional around 4 billion sterling of investment there. So that's good for a number of stocks within our universe. Fourthly, support services. High Speed 2 and High Speed 3 are expected to deliver a real significant economic boost to the country, around 7 to 10 billion of regional infrastructure, as well as the autumn statement commitment to 15 billion expenditure on road investment. Again, that'll feed into stocks like Kier in our coverage. Then fifthly, we've got broadband provision, further commitment to superfast broadband infrastructure within the UK. That's really beneficial for internet retail businesses, and also we're going to see further rollout of the Internet of Things. So that feeds into some of the semiconductor plays that we're interested in. And finally, fintech and P2P. So we're seeing further consultation, which will develop over the summer to introduce P2P lending into ISAs, which will allow you to get a more significant rate of return, albeit with additional risk in most cases, within your ISA. And they're also introducing an API for fintech firms to be able to use bank data, which will enhance suitability, but also help those diversified financials. So the market reaction here, we've got some of the stock prices. You can see a big move in Foxtons. It's one of the London agents. Hargreaves had a big move on the announcement. That's that red line, if you can see it there. Premier Oil was a beneficiary eventually. Barclay Group ticked up over the preceding day. The banks were slightly weak because of the additional bank levy, and here we've got Kier, which was a little bit better on additional infrastructure spend. So the real move, though, in the week was the FOMC meeting. So here we saw a dovish statement from Janet Yellen, which actually pushed back the expected next rate rise. So she took the patient word out of the vocabulary, which was expected, but said they would need additional confidence in the data, which hasn't come through yet. So we've seen that US data starting to fall a bit. So April becomes unlikely as a time that they might raise rates, and the probability of a June hike has now gone from 40% to 10%, so that was quite a significant fall. So here you can see the dot chart that the Fed produced. This is their expected rate curve going out into 2017 and onwards, and as you can see, that rate rise has been pushed out this way. So what they acknowledged in the statement was that the growth rate in the US economy had slowed and export orders had been put under pressure by the stronger dollar. As a result, it was with the sense that interest rates were going up slower, the dollar fell quite significantly as a dollar index by around 3%. They also downgraded their expectation of where full employment is, previously from 5.2 to 5.5 down to 5% to 5.2. And that explains why in the last strong jobs number we didn't see any wage inflation, because at 5.5 we're still well above that full employment level where wage inflation starts to come through. So the key move in the US markets was the 10-year yield, which fell back down to around 1.9%. That was good for stocks because lower interest rates for longer is good for margins. So we also saw a big move upwards in some of the utilities and staples where people were getting a little bit nervous about their relative value because they price off their dividend yield, and if bond yields are going up, they're less attractive relatively. But also the long duration assets, such as the tech companies, where the future earnings are a long way in the future and therefore discounted at an interest rate. If that interest rate goes up, the present value of those companies goes down. So we saw the reverse of that. So good day for the Nasdaq early in the week. Equally, we saw the People's Bank of China cut their rates again by 0.25%. This was acknowledged in acknowledgement of weak data, which we talked about last week. So as we can see here, we've seen a number of rate cuts now. And despite weak data, the Chinese market, the Shanghai composite, continues to climb that wall of worry. Next week, we've got, in terms of UK stock, we've got Wolseley on Tuesday, which we'll talk about in a minute, of the Killik stocks. And we've got AMEC, which we're interested in on our mid-cap service on Thursday. Just a quick word on AMEC. That's now yielding around 4.5% on around a 11 times multiple. Big beneficiary of that additional investment in North Sea oil. So we saw a stronger share price this week, and it's also started to decouple from the oil price, having been a big faller as a result of the weaker oil. As people start to understand that it's a consultancy business, it provides employees into the oil industry. It's not necessarily exposed to the production of the product. So finally, Wolseley continues for us to look attractive as a dividend grower. They're growing their dividend, which is currently 2.4% at a compound annual growth rate of 15%. So that could double in 5 years. It's got attractive end markets. And it's got a lot of US earnings, so a significant US dollar earner, which is helping earnings at the moment. So that's it from me. Have a good weekend. Thanks very much.